Country at Morgan Stanley. His name's Chris Toomey. He's back with us at Post 9. So you and Harvey, Chris Harvey, have obviously been hanging out. You think it's time to sell also? Sell before May and go away?
Yeah, I mean, I think we've been fairly defensively positioned for a while, and we've been pretty open about that. I think tomorrow starts the earnings season in earnest for Q1. If you look at last quarter, down earnings. This quarter expected to be down about 9%. That's with top-line revenue growth being at 2%. Second quarter down again. So you're talking 3 quarters of negative earnings. This is an earnings recession.
It is.
And if you look at what the street is calling for, 220 on the S&P 500, 18 times multiple, that's pretty expensive for us. And in our mind, we think earnings in reality are going to be closer to 195. And I think that's where the rubber is going to meet the road.
See, the bears, or those who are more cautious, they, and with no disrespect in any way, they all tell the same story because the story is easy to tell in the same manner. It's like, you know, the economic news is showing deterioration. Earnings are still too rich, and those estimates are going to come down. Stocks are too richly priced at these valuations based on what earnings really should be. Right? I mean, I've kind of laid it out. It's pretty easy to do.
Yep.
But that's the point. It's kind of easy to do. What if all you guys are wrong?
Well, I mean, if we're wrong, I think we're in for an even worse outcome. I think the further the market goes up, the more those fundamentals get worse, and the more downside we're going to see.
Why so?
So, I mean, I think, look at a situation like financials, right? It's the second most important part to earnings this year. Everyone was concerned about deposits. Right now, I don't think it's a solvency issue. I really think it's a return issue. If you look at the basic business of financials, you know, you're lending through deposits at one rate, and then you're loaning out to earn money. Right now, that's inverted.
The net interest margin is what you're talking about.
Right. So, you know, Rob Sechin was on earlier. He talked about peak net interest margins. That's going to be a critical problem within the financials, which the Fed spoke about in their minutes. You know, they were ready to go 50 basis points and halted because of their concern about what's going on in the financial markets. And I think that's only the first problem. I think the second problem is if you look at a report that Morgan Stanley put out last week, focusing in on the debt wall that we're going to be seeing over the next 2 years. It's $5.3 trillion. A big portion of that is commercial real estate.
So you're one of those who are, you know, getting more worried about the commercial real estate effect as well.
Absolutely. I mean, you're in a situation where rates are significantly higher than when these loans were priced. They have to reprice, and valuations have to come down 20 to 40% on a lot of these properties. That's going to be a really troubling situation. And don't forget, the banks don't just lend in these situations. They also invest through CNBC.